Good morning, everybody, from fabulous Las Vegas. This is Kirk Spano with June 14th, 2019. And as always happens when I'm in Las Vegas, something exciting happens in the markets. Sometimes it's good, sometimes it's bad. Now it's a little bit of both. So let's get right to it. Let's start with the articles that I'm writing. Today we'll just be doing the webinar with a little bit of a summary. But poker investing in 3 weeks in the desert. I will say it's interesting to me, the correlations between poker and investing. So I think that, if you're not a poker player, watch some on TV maybe and play a little bit on the side or play a little bit online. And what you will discover is that there's a lot of correlations between risk management, volatility, decision making, how much of your money to commit to a particular bet or asset. A lot of things that work together. A lot of ideas about how to manage risk that apply both to poker and investing. And if you didn't know this, there are quite a few hedge funds that will now take their top candidates and have them play poker against each other to rate them on their skills for managing risk and asymmetric upside opportunities, which, there's a lot of people who like the idea of the slow grind, of the low volatility way of making money. And the reality is that low volatility comes from having a good asset allocation and a good mix of assets, and not really from having low volatility assets. It's just from the diversification. We know that having a slow growth basket of stocks that have betas of 0.5 or 0.6, measures of volatility against the S&P 500 index, can have the same downside, and typically do have the same downside as the S&P 500 index, however, have less upside. So folks who are out there looking for dividend stocks that will pay them 3 or 4 or 5 or 6% in income often get to a point in the economic cycle where those stocks get crushed, because if they don't have growth characteristics that will support those dividends long term, and they happen to have debt or engineered balance sheets, then the person may not only lose the dividend, but when the dividend goes away, as is the case in about 1/3 of the stocks out there, then the stock also gets crushed. Take a look at CenturyLink. CenturyLink is a company that just has a lot of market pessimism because they are a landline service, and their fiber optic network and their enterprise business, I don't think get valued very well. And that doesn't make sense because 5G is going to require their fiber optic lines. So eventually they're going to raise rates, but people don't factor that into the equation. And eventually somebody probably just wants to buy that fiber optic network, but people don't factor that into the equation. So in the short run, when CenturyLink had to cut their dividend, that stock is down, 50, 60% from when we started buying it, and down 75%, give or take, 70, 75% from its all-time high. So about 1/3 of the companies in the S&P 500 that pay a dividend have engineered balance sheets. Assets that really aren't that valuable, not nearly as valuable as say, a CenturyLink's fiber optic network or enterprise business. And they float up there on a narrative from people who pitch high yield as some way to pay an income that's reliable. And really that income is not reliable, again, because once those companies have to face up to their balance sheets being highly engineered on top of very low growth or no growth profiles, or even shrinking revenue streams, then they run into that brick wall. So I'll just throw out this warning right now before we get into the oil. About 1/3 of the dividend stocks that are being recommended with investment services are going to take 30, 40, 50% haircuts here in the next few years whenever the economic cycle really slows down. And of course, all the signals are that that's going to happen in the next several quarters. So we'll see if that's true. We'll see if we can avoid an economic slowdown, but I doubt that we will avoid it. You've heard the Fed talk about inflation, low inflation being transitory. It's not. Low inflation is a secular trend that will last for decades because of the demographics. And they can talk about low interest rates propping up the economy. They can talk about really anything that they want to talk about the transitory nature of low inflation. But the reality is that the combination of demographics, high global debt, and technology causing deflationary impacts are going to last a very long time. So we have to ask ourselves, what policies will break us out of that? And really the only thing that I see breaking us out of this borderline deflationary scenario, that loose money has really done all it can to prop up, is some sort of massive rebuild of infrastructure of the planet. And the one place where you can see that obviously is energy. You can see the world going to a smart grid, powered by alternative energy, electric vehicles, the electrification of how we transport ourselves, all of our devices and whatnot. If you were watching the news, Airbus announced that they will probably introduce a hybrid airplane. So all the folks that talk about, you can never have an electric airplane, bullshit. Yes, you can. It'll start out as hybrids, and maybe that's where it stays. I wrote an article 7 years ago now on Market Watch where I talked about how automobiles would go hybrid, because in my mind and in Toyota's mind, it makes a lot of sense that we have a 60 or 100-mile battery in our cars, but then a fuel tank. Now, for environmental reasons, that's not what the push is. However, if we can cut emissions from vehicles in half again, and we can get the first 60 miles that we drive from a small battery, then these cars become very efficient and very low impact on the environment. And I would take a look at a car like the Toyota Camry or the RAV4, which is on the Camry frame, and those cars are only 1,000 or 2,000, 1,000 in the case of the Camry, 2,000 in the case of the RAV4, RAV4, however you say it, more expensive than the internal combustion engine vehicles. So given a choice between a $30,000 Camry or a $31,000 Camry hybrid, which one are you going to buy if the first 60 miles, 70 miles you go every day are basically free, from the regenerative braking? That's a very economic thing, and it's ready right now. So we'll see if people start buying hybrid Toyotas. I think they would if Toyota just got rid of the other alternative, if they went just straight hybrid vehicle. And I actually think that's what they will announce sometime in the next year, maybe 2 years, but they've already hinted at it. I think that by the 2021 model year, which will be middle of next year sometime, you're going to see that Toyota has gone all hybrids on their fleet, with the exception of the trucks. I'm dying for a hybrid 4Runner. I don't know if they'll do it. They are introducing a hybrid, or they actually already have a hybrid Highlander. So Toyota's right there. And I think that they might be a gigantic winner compared to companies like, GM or Ford, who are really struggling with the whole EV scenario. Ford just put a big stake in Rivian. Fiat Chrysler has announced a new deal this week. I don't even remember who it's with. Was it with Google or Waymo or I don't remember, and manufacturing too. So, this transition is happening. And that is one of the reasons I talked about in this week's article, that we are in the midst of a paradigm shift. So the paradigm shift that we are experiencing, and this article is remarkably popular. It's up to like 700 comments. But what we should be most aware of is that the shift towards oil, away from oil and coal, is moving faster than anybody thought. So when you model out when we're going to have peak oil demand, it comes in somewhere between the middle to late 2020s and the early to middle 2030s. And it really depends on how fast battery technology moves from the lab, where we know that we have great batteries, to manufacturing, where we still struggle, especially when it comes to making bigger batteries. So if we can see in the next 2 to 4 years another giant jump in battery technology, which seems very likely, that means that 5, 6, 7 years, the manufacturing process is very efficient. So that by 2025-ish, you're seeing EVs and hybrids that make it just economically nonsensical to buy a gasoline-only car. So your decision will be between an EV, if you want to go 100% electric, or a hybrid vehicle, which will be the same cost as a gasoline vehicle at that point, but offer you the first 60 to 100 miles without having to fuel up. We'll see. What's important about that is that most people drive under 60 to 100 miles per day. 95 or 96% of all miles driven are short distance. So we'll see how that plays out. But that really goes towards my idea that peak oil demand is right around 2030-ish. So as you can see from this chart, we have rising oil demand, and everybody who criticizes this idea that we're moving away from oil says, oh, look, oil demand goes up 1 to 2% per year. Well, that doesn't mean it will. That means that it has. And it used to go up by 2 to 3% per year. Before that, 3 to 4% per year. So the curve for oil demand growth has been starting to bend down versus bending up. And at some point, it's level, it's perpendicular to the axis, and then it turns over. So if we start selling more EVs and hybrids by the second half of the 2020s, you'll get a time lag, right? Because it takes time to retire the gasoline-powered vehicles. But around 2030, demand for oil starts to turn over. And this is really a long period here. From here to here, you're only looking like at a 10 million barrel per day drop. It just looks precipitous because once you get over that hump where lots and lots of cars are getting retired and there's taxes on them for renewing the registrations, that's when oil demand really falls off. It won't be gradual. It'll be some sort of kink in the curve, and then a 5 to 10 year period where it just really, the downward move accelerates. Could this curve be pushed out a few years? Sure. But I think that this is probably pretty close. 2035-ish on the outside, 2027, 28-ish on the short side. But 2030, I'll put my money on technology continuing to get better. That's the trend across the board. Why would it be any different with cars? I answered some of the questions from that article. And if you read the comments, you see the backwards thinking, anti-climate change guys, the non-believers, the people who put politics above their investment analysis. I'll just say, I am going to write an article at some point explaining how I'm going to take money from climate change deniers. Now, it doesn't really matter what I believe as far as climate change. Do I believe man causes climate change? Yeah. Does it matter to my investment thesis? Not really. There's a correlation. Somebody on Twitter, this Heather something or other, said that I made an argument that you should be divesting your fossil fuel stocks. No, I didn't. I pointed out what is causing the volatility in oil stocks right now. I believe that there's going to be a huge, very powerful snapback in some oil stocks, not all oil stocks, but the companies with good balance sheets, just like the dividend payers, the companies with good balance sheets, and they can provide revenue growth and increasing earnings margins are going to do very well. So should we expect oil stocks to go to zero anytime soon? No. And honestly, if investors don't start buying these oil stocks soon, that are just beat to trash, beat into the ground, the companies are going to start getting taken private. And that basically means that the executives and the management and a very small group of shareholders, your biggest few, are going to take all that revenue and all those earnings and pay it to themselves. So the divestiture movement is really actually pretty stupid when it comes to the idea that they're somehow punishing the industry. They're not. They're punishing shareholders, but they're not punishing the industry, because the industry will make the money. They'll just distribute the earnings to fewer people. And then they'll create a whole new class of billionaires and multi-millionaires, rather than helping the folks who have their money invested in oil stocks. Now, how strong is this divestiture movement? It's strong enough to cause a lot of pressure on these stocks now, but once Norway is done selling, and I think they must be close to being done, selling the $7.5 billion that they talked about, and the organizations that have committed to selling off do that, you'll get that capitulation. I think that capitulation has happened in the last couple of weeks. Half of all the oil and gas stocks have actually hit 52-week lows. So, this chart is pretty clear. This looks to me like a triple bottom. And that means that we should get this giant run up. What could be one of the catalysts? Well, as I wrote in the Day 2 blog, there is a lot of things going on in the Middle East. And you're getting some of the crazy arguments, the false flag arguments that somehow we or Israel or our proxies attacked these tankers in the Gulf. And I guess that's possible. The real problem is that the Trump administration lies so much that they don't have a lot of credibility. So the innuendo and rumor that it wasn't Iran that attacked the tankers gains strength. And even I struggle with the idea that it wasn't somehow a conspiracy among the Saudi Arabia and the United States and Israel to attack our own tankers. I don't think that's what happened, but I understand when those rumors run away based on the incredible lack of credibility or the huge lack of credibility that the Trump administration has for telling the truth. President Trump pointed the finger at Iran for the attacks on the tankers, said that they had video of the speedboats doing it. I haven't really seen that video. I don't know if I can make it out. You know, they say that this is it. And it seems to be legit, right? It seems to be legit. Placing some bombs on these tankers in the middle of the night. But how do I know? So let's suppose that Iran did blow up these two tankers. What does that mean? Well, the price of oil has gone up a few percent. You would think that it would be a lot more. But again, the rumors probably hold this back, as well as the idea that we're going to have a big economic slowdown next year, and the idea that we're going away from oil. As I showed, demand for oil is going to go up for a while yet, better part of a decade. And I would still suggest that the economy, rather than being in huge trouble, is just in a slow growth phase. So if you Google slow growth forever, let's get rid of Heather here. Slow growth forever. You don't have to break it apart. Here's the hashtag on Twitter, slow growth forever. And I've talked about it as a central theme for years now. It is not an idea that it's hard to figure out. Again, going back to what I stated earlier, everything revolves around the slow growth forever hypothesis, which is that demographics, aging demographics, global debt, and technology have just conspired to create deflationary pressures. And those won't go away until the boomers are all retired and younger populations start to take over from the older. That really will only be when the emerging markets have more power in the economy. China, Japan, Europe, and the United States are all aging economies. The United States has the offset of the millennials. China, Europe, Japan don't. So we need India, Vietnam, Indonesia, the African nations, Middle Eastern nations, South American nations. We need all these areas that have younger populations to become bigger parts of the global economy. One of the problems the United States has with that is we are pretty hung up on being the head honcho, being the big man on campus. The absolute value of our economy is not really what matters. What matters is how much our standard of living improves as a population. Because we have amazing geography, we have the best geography on the planet, and that is a big advantage that doesn't go away. It is a sustainable, durable advantage, comparative advantage. And because we have good rule of law, because we have relative stability of the political system, the legal system, because we are remarkably safe from the outside. You know, we steal and kill each other at stupid rates. The United States will always have a great economy. Relatively speaking, nobody else can match us and won't be able to this century. Now, that doesn't mean that China's economy won't be bigger on aggregate. But their per capita gross domestic product, their standard of livings, they can't catch up to us in 2 or 3 generations, much less the next couple of years. So we will see how that all goes. In any case, geopolitical risk in oil is huge right now. And the question I would ask is that given that we may only see, we'll only see a minor slowdown in oil demand next year. Let's suppose that there's no growth in oil demand for a year because we get a small recession. And then it starts resuming up. And we've high graded another 4 million barrels a day from the shale. That over the course of the year is, what is that? That's 1.4 billion barrels. Be another 1.4 billion barrels gone from the cheapest, easiest to get acreage. Then they have to move on to oil that's more difficult to get. And while technology has been creating level pricing and doing that, the price of oil, the break-even price, has stopped going down for the most part. So all these curves, think about things in terms of rate of change. All of these curves are telling you that the price of oil is going to go up, and now we have the geopolitical risk on top. Something's going to cause the price of oil to get in that 80 to 100 range. Maybe it won't be geopolitical. Maybe it won't be the supply-demand economics in the short term. Eventually, we know what happens, at least for a while, until demand turns over. Consider this. What if the Trump administration is no longer in charge in a year and a half? I really do put it at 87 to 94% likely that Trump loses next year. The canary was the midterms. The Republicans lost by 8.8 million votes. That's massive. It doesn't happen that way usually. So if people come out to vote in the presidential election like they did last time, and then you take into account just the demographic changes in the last 4 years, and the likelihood that Trump really did get out pretty much every way that he could get out, and some of those people are walking away now. The statistical fact that only one demographic group, white guys over 50, support Trump, and only one subgroup, racists, support Trump. One minority group, right? And I count racists as a minority group because I don't think it's most people. I just think that the people who identify with white nationalism and things and white superiority are very loud about it. If the Democrats take Congress and the presidency, or even just the presidency, what will regulations look like on oil and gas at that point? They'll at least go back to the Obama era, correct? That means it'll be harder to drill on public lands. They won't be issuing offshore permits. And it'll be even more difficult to build infrastructure for fossil fuels. On the infrastructure side, that means that the existing infrastructure becomes more valuable because there's more relative demand and no new pipes coming on, no new refineries, no more refinery expansions. We have gotten refinery expansions. We just don't get new refineries. So think this through as to what is the value of these assets if the price of oil goes up and entry becomes more difficult. I had somebody tell me this week that I've lost faith in the oil market, in the oil stocks. Well, here's what I would say to that. Why does faith have anything to do with it? Just do the analysis. And while I've been clearly early on when this last bull market in oil and oil stocks would start, and in investing that often just translates to you're wrong, what happens if over the next year or two or three, price of oil gets in that 80 to 100 range like I think it will, and the oil stocks keep becoming more and more profitable, at least among the companies with good rock and good balance sheets. There's 93 companies in my list of oil and gas stocks. Take a look at the ones that have shareholder yield, which is debt reduction plus dividend buybacks plus share buybacks plus dividends. Devon Energy is one that I keep mentioning. Apache's interesting to me. I haven't got into it because I think it's a complex company, but they could get bought out the way Anadarko did. WT Offshore, what's their deal? They get oil from the Gulf of Mexico, and with us unwilling to build a pipeline from Canada that would free us from OPEC, this oil is more valuable because of the grade of oil that it is. Going down. Some of these Canadian companies are interesting. Their problem is that they're having a hard time getting the oil in the market. Imagine if Keystone XL got built. Not only would we be able to ignore the Middle East, at least as far as getting troops on the ground, we wouldn't have to import that oil from the Middle East. Building the Keystone XL pipeline extricates us from being the Middle East police, from being so deep in there. And one thing to keep in mind, and just this should be important when you think about who you're going to vote for. The Iran nuclear deal was a good deal. Here's why. Because they were just waiting out the Ayatollah. The guy's got to die sometime. So by lifting sanctions several years ago, the Iranian people started to live better. The whole hate America thing started to go away. But now we're putting sanctions back on them, and we're the bad guys again. There will be a transition of power there at some point, and alienating the Iranian people probably is a bad idea. You have to think in chess move terms, multi-level thinking, multi-dimensional views, not this checkerboard theory that Bolton and Pompeo have sold to President Trump. There were better ways to stand up to Iran, just as there's better ways to stand up to China. I'm not saying that we shouldn't stand up to Iran and China. I've argued in print and in interviews, we have to do that. But there needs to be ways to do it effectively, and that involves having allies that work with you. to build ring fences around actors that need to be controlled. We haven't done that in the last 2.5 years now. We've alienated our allies. And while it may play to a certain base, think about the effectiveness of what's going on. So just keep working through that. Ultimately, the cycles play themselves out. So again, if I'm right and President Trump is out of office in 1.5 years, a lot of things change. They probably snap back very quickly. As you know, I do have some very super minor connections to the Democratic Party. I don't think you're going to see a play nice approach in 2021 if the Democrats are in charge. They're going to jam everything they can down the Republicans' throat because they're so pissed off at President Trump and Mitch McConnell. There's not going to be negotiations if there doesn't have to be. If the Democrats can pass it, they'll do it. And I think you're going to see more Republicans join the Democrat Party, and you'll see the Blue Dogs come back with a lot of force. Because above all other things, Congressman wants to keep his job. So, in any case, when you go back to these companies, you can see on the screen very good shareholder yields, and these have been improving. I've been showing this chart, this screen over and over again for the last 7 or 8 months. More and more companies, there was only like 7 or 8 that were, positive shareholder yield. Now we're up to 25, 30. A lot of companies I've mentioned, they were negative, now they're positive. Parsley Energy, EOG, Encana, Pioneer Natural, and they're all trending upwards on their shareholder yield, which means they're reducing debt and then returning cash to shareholders in one form or another. Of the majors, I would just point out, if I was going to own a major, it'd be Total. Royal Dutch Shell is close. Chevron and Exxon are down there below. And why is that? Because they have a lot of political risk in the United States, a lot of legal risk. They're getting sued. They're going to keep getting sued. And they're going to have to make settlements. Ultimately, I'm fairly certain that Chevron and Exxon get broken up. So we'll keep that on our radar screen. All right. Let me take some questions here. And just go back to what I started with. The same deal that applies to oil and gas stocks applies to dividend stocks. Is you have to have growth characteristics that make sense. You have to have balance sheets that make sense. You have to have management that wants you to be on the same side as shareholders. So we'll see how all these things work together, but I'm not so sure that that's going to happen. I do think there's one more rally in oil stocks. I'll get out of XOP first, and then I'll start whittling away at the stock positions over the next few years. But XOP, because it includes some of the companies I don't want to be in, I'll get rid of, and I'll just keep my basket of 7 or 8 stocks. There are a couple options I want you to keep in mind right now, and we're going to talk about those, in particular at fundamental trends. But I think there's 2 trades you can make on oversold conditions. And we might get a stock market correction here again. We got the relief rally off of the May correction. I think that's all we've really been seeing here early in June is the relief rally. But if you want to speculate on a fake trade deal between China and the United States, maybe buy some QQQ calls. Why QQQ? Those are the companies that have gotten beaten up the most. Those tech companies. And QQQ is easy to trade. So I think QQQ calls, if we get a little bit more correction here leading into the G20, might be something that we'll look at. The other call options you can buy are all of these oil stocks that we've been looking at. Call options on all these oil stocks. You're going to have to roll them if this thesis plays out longer than shorter. But the upside for these is just incredibly huge. I mean, where's the other chart that we had? Right here. I mean, take a look at that. That is a triple bottom. Absolutely, that's what that is. So even a quadruple bottom. And I look at this whole thing as one bottoming process. Look what happened here. Why is this a loss of faith when we see that happens? Now, I don't know that we go back to these highs. But this level right in here, see where it keeps hitting against? That still implies roughly a double in the price of oil stocks. And the good oil stocks could do really well. We could also buy calls on USO again. I just think that the oil stocks are better levered to the price of oil than the actual price of oil. So the oil stocks tend to go up more than oil when oil goes up. Does that make sense? Right. So all of the companies that I've liked, that I wrote about in the Dirty Dozen oil stocks and Permian stocks you should buy, I like them all. There's nothing that's changed about any of those if oil prices go up, and there continues to be a slow squeezing out, which should be faster, of some of those wildcatters who provide marginal production. Some of these teeny tiny companies, the bankers are at fault for keeping them in business. The bankers should let those little teeny tiny companies, and there's enough of them, at the margin they're important. They provide 10, 11, 12% of the oil. So if those small cap oil companies are told, hey, we're not giving you money if you're not profitable, you let them go bankrupt, take the secured debt, take the land, and then sell the land. They're more likely to get the bank. The banks don't have to care about shareholders. They just want to get their money back. Sometimes taking the keys back from to the house is the better idea. And I think, and I'll write about this, and I'll throw in a bunch of small cap examples, companies that aren't going to get bought, because they're inconsequential. A lot of small oil companies that the banks would be better off just taking the keys to the house. All right, let's take a couple of questions here. Yeah, I'm very bullish on Occidental. I think they're a better option than Exxon or Chevron if you want dividends. So if we get a recession, like I said, oil demand flattens for 1 year. Big deal. And given where oil stock prices are right now, how much worse can it get? And seriously, how much worse can it get? So it would be those teeny tiny marginal producers that get wiped out. And higher oil prices usually mean a slowdown in the economy. I think that correlation, though, is going away because the demand growth for oil has already turned over. So I don't think $80 oil has that much impact on the economy. And I don't think that the trade war is going to slow the economy down as much as other people think either. The correlation between global trade and global GDP has broken apart a bit. Why? Because supply chains are moving based on technology. We don't need to trade as much anymore as we have in the past. Why? Because a robot can build something just as good in America as it can in China, as it can in Indonesia, as it can in Europe, as it can in Mexico. Comparative advantage means that a country that produces widget A sells it to a country that's really good at producing widget B, and there's trade. But now widget A and B can be built pretty much anywhere. What really is the tradable thing that's out there? Commodities, right? Because those aren't manufactured goods. And services. What is the United States really strong in? Commodities and services. That's why the trade war doesn't make a ton of sense. Because you're influencing how many commodities you sell and how many services you provide. Why? Because you're looking backwards at manufacturing processes that don't really even exist anymore. Supply chains that are already changing due to technology, due to machine learning, robots, automation. And that's why I say you can support standing up to Iran and China, but look at the way that it's being done, and you'll realize it's ass backwards. So we'll see. Somebody says the banks won't stand up to the little oil companies. I think they will. At some point, they'll have to. They'll still keep supporting the bigger companies, though, because they can't absorb that type of those types of assets. But if some little company on the fringe of the Permian or the Bakken or in Colorado says, hey, we need money to sustain our drilling, the bank can say, you know what? We're going to liquidate you and take what we can get and be done with you. The little companies, they can do that too. They can absorb that. They can go through that trouble. They can't do it with, a $10 billion company. But they can do it with almost all the companies that are under 500 million. And there's like 300 of them. So there's 500 companies drilling in Texas. But like 35 of the companies are 90%. So all those little teeny tiny things on the fringes, those bankruptcies have already started. And I think they're going to get wiped out soon. And that means that, about 1 million barrels a day of American oil production switches hands. And why would Conoco and Occidental and Chevron and Exxon move away from the center of their plays? They won't. They'll do what they have to keep their leases, but they're not going to develop out on the fringes until they have to. Right? So that's what's coming. What will the impact of Fed cuts be on stocks and mortgage rates? I don't think much, and I don't think it's going to happen. I don't think the Fed cuts rates this year. Maybe next year. We'll see. But as I've said before, what really would impact the economy is a really smart infrastructure package that focused on a smart grid. This whole shovel-ready thing, there's bridges and roads that have to be repaired. Great. Let's figure out a way to do it. But we really need to transform the energy system. The water infrastructure system in particular has to be completely overhauled. These are projects that'll take 20, 30, 40 years. So let's get on it. And this new Green Deal, everything that they say needs to be done does need to get done. But it doesn't take government money. That's where, Ocasio-Cortez doesn't get it, is that if you just penalize coal, if you phase coal out, then that's all you have to do. Then everything else develops itself because economically it has to. You don't have to give money to alternative energy. All you have to do is make coal pay its way. Coal has been getting free ridership for decades on its environmental impact. I think the very easy way to jumpstart everything is phase out coal, get rid of coal exports, first of all, and that would crash the price of coal. And then tell the utilities, you got to get rid of the coal, your coal power plants in 5 years. We'll give a couple exceptions, give you 10 years on a few of the key power plants that are cleaner. If you do that, then you fill that entire gap with alternative energy. Solar and alternative energy are growing faster than any other sources. EIA has those charts up. I put those in this article somewhere. Right? We know that alternative energy growth alternatives are the only things that are growing. Everything else, all the fossil fuels are turning over. So it wouldn't be that hard to do. The government might have to provide loan guarantees, but we really don't need to fund things outright. Just give the utilities loan guarantees to build out the alternative energy system and the smart grid, and we could be, we could surpass the Paris Agreement easy in the next 10 years. That's it. Kill coal, and then loan guarantees. Done. And you get this massive build out, and all these people who need jobs get jobs. Yeah. So there's already talk about oil companies going private. Yeah, I hope that doesn't happen. I mean, we'll get some of our money back if that happens, but we wouldn't get the giant rally. Like I said, if oil companies go private, that completely just completely makes the divestiture movement look stupid, right? Because they want to punish the oil industry, but really they're just punishing the shareholders, and all the money ends up flowing to management over the next 20 years. Gold. I became constructive on gold late last year, right? And I'm liking my Newmont Gold, my Newmont Gold Corp. I'm going to hold on to that stock for a while, right? Clark, I disagree with you. The non-smart Congress are 25 or 30 Republican senators. We're 25 or 30 senators away from having a good Congress again. We have to get rid of some of the hangers-on in the House as well, on the far right. But I have no beef with most just general conservative Republicans. Just like I don't have much beef with liberal Democrats. It's the extremists in both parties who drive the narrative and provide the swing votes. Got to get rid of them on both sides. And I like what. Let's use Ocasio-Cortez as an example again. She's right about a lot of the problems. So is Bernie. But their solutions, no. You have to let markets work. Why? Because it corresponds to human psychology. You can't legislate away human psychology. Some people want to get ahead. Give them the opportunity to provide goods and services to other people. If they get rich doing it, so be it. Make sure they pay a fair wage. Make sure they take care of their end of the environmental donkey. So, in any case, it is it's been about an hour, and I will close with some poker. So, in the last 3 days, I have played quite a bit of poker, and I've been profitable every day, except the first day. First day, I walked in, sat down on a table, made three of a kind, and then two sets. What that means is three of a kind is when you have like a 9 in your hand and 2 9s get on the board. I did that, and I lost because the guy in the blind had one of 2 hands that could beat me. And I made 3 queens, a set, and 3 aces. These are all hugely powerful hands. And I bet them all hard. And people got lucky, and they decided to gamble, and they won. They got the cards they needed, even though I was between a 70 and 80% favorite on every hand. Lost 3 of them in a row. I was down $900 in 2 hours. I've since made all that money back and then some. Played in a poker tournament. Very tired after I lost that $900. Didn't think I'd be in all day. 12 hours from 1 p.m. to 1 a.m. I finished 12th. And I lost when I tried to gamble on creating a huge, powerful chip stack. I tried to triple my stack in one hand. And I was about 25, 22% likely to do it before the hand started. But I bet on some chips thinking, well, if I get a good flop, I could either guarantee that it happens or get a good draw. So once the flop came out, I was getting 3.5 to 1 on my money, and I was 50-50 to win the hand. That's great asymmetric upside. I lost, but I had a chance to more than triple up. When we invest, we want to take shots at asymmetric upside. Right now, and I know that we got in too early and we didn't trade this all that well, but right here on that triple bottom in the oil stocks, there's not a lot of downside left. Not if you stick with companies with the improving shareholder yield. The upside are doubles and triples. The downsides are 20, 30, 40, 50%. So if you manage that part of your asset allocation well, if you've been slow to the game on oil stocks, you're getting another great chance on this triple bottom. All right, so today my girlfriend comes in town. I will not be gambling much the next few days. Going to go to Penn and Teller tonight, I think. And I'm going to go check out one of the dispensaries. I don't use marijuana. I don't like the way it makes me feel. And I haven't been drinking in Vegas. I haven't had a drink yet. So the diet thing has worked so far. I'm drinking a ton of water and stuck with meats and vegetables so far. I had some sushi. So I had a little bit of rice, 3 mouthfuls of rice. And I did have 1 spoonful of the creme brulee over at Oscar's. If you haven't been to downtown Vegas, I tell you what, it's time to start coming back. They've put a lot of work into it. There's 2 more buildings going up. Oscar's is amazing. The Golden Nugget is amazing. Yeah, I think the Golden Nugget is the best hotel down here, but I haven't tried them all, so I could be wrong. But the Golden Nugget is really cool. Gets a good group of people. If you're a poker player and you're not in Vegas for at least part of June, you're not really a poker player. So, yeah, Clark says I need to move to Italy where I can eat right. Yeah, you know what? I might go to one of those towns where they're paying you to move to at some point. I'm not tied to America full time, although I am a little bit more tied to it now. My daughter is pregnant, so I will be a grandpa when I'm just short of my 50th birthday. She couldn't have waited 3 more months. But, yeah, big year. Daughter will have a baby in December, and then I turn 50 in February, which means I'll be eligible to play in the senior events on the poker tour. So, yeah, in any case, Somebody asked about if you're already allocated to oil and then some, you play out the string. I don't know that you need to add anything. Remember, you don't have to make your money back where you lost it. That's an old saying. Buy some of these smart stocks, some of these tech stocks that are getting beat up. You know, the companies that I've been adding to the sustainable growth list. And if you've noticed, I did do the retiree list, the retiree dividend list. I'll write about that next week. And I'll show you what the criteria were. There's overlap between the dividend growth list and the retiree list. I peeled out some of the higher volatility dividend growth stocks because I know retirees want less volatility, and they're willing to tolerate less growth as long as they get a good income and, you know, they don't have to worry so much. So will the retiree dividend stock list do as well as the dividend growth stock list over time? Probably not, but it'll be a smoother ride. You'll pay a little higher income. So, you know, different strokes for different folks. The sustainable growth stock list, I'll give you a hint. Take a look at that ARC Innovation Fund. Half of those stocks are on our list. And I'm just telling you, Tesla has so many avenues to generating revenue and the potential for some huge deals to license out their technology that I think that you should have at least a little bit of Tesla in your portfolio. You know, it got down to 180, and that was kind of the area that we were looking at of buying, you know, nibbling in if you didn't have any. You know, that wasn't the pile-in price, but, you know, around 180, you should have owned a couple shares. It's around, 200, 210 right now. You know, you can try to game the system and try to save, you know, a couple bucks, but, you know, put a quarter or a half or 1% into Tesla. And then if it does crash one more time, go ahead and get it. But money's not an issue. You know, he raised $2.5 billion, and people jumped all over the whole, we could be out of money in 10 months if we don't tighten our belts. Well, they tighten their belts. The whole 10-month thing doesn't apply anymore. They're going to have a record or near record quarter in Q2, right? Because there is that kind of sigh in Q1, you know, because they got a bunch of business in Q4. And Q1 was a little bit of a pullback, and now it's moving back up again. I'll tell you what, when Tesla starts selling cars in China, when they license out their platform to other car makers, which they will, that stock's going to scream. And at some point, you know, they're stretching out the calendar, waiting for the calendar to catch up to them. At some point, their solar business, their battery business is going to be a big deal. And I think that is only about 2 years away. How soon will the market react? I don't know. I've chosen to take a starter position now that I think I will never trade out of. And if we get one more pullback, for example, on a shallow recession or more bad China news, you know, then I'll add to it. You know, we don't have to be in a hurry. Wait and see what happens. You know, scaling in doesn't mean every time the price changes a few percent. Big prices, but big price changes, that's when you scale in. And when catalysts get closer is when you scale in. So folks need to understand how Tesla's technology works. They've already shared a lot of their patents, but their production process is different. That's not something that you just steal, that just magically appears somewhere else. So the way it'll work is the same way that it's working with Rivian and Ford. Rivian has licensed out their platform, their sled is what they call it, you know, what the car gets built on top of, to Ford. Ford is going to start building cars on that. Tesla is going to do the same thing. It's starting to really look like Tesla and GM are going to cut a deal. I always thought it was going to be Ford and Tesla, but Ford went with Rivian because it was cheaper. Ultimately, I think that works out for them the same way that a GM Tesla tie-up would work out. Or maybe it ends up being, Tesla and some other company. We'll see. There's a lot of, internal combustion engine car companies that need help. And they really can't afford, with declining revenues. David Zanoni covered that we're probably at peak car sales right now, at least for a while. And that's going to put pressure on traditional car companies as they have to transition towards EVs and hybrids. And again, my bet on the car industry, besides Tesla, my hedging bet would probably be Toyota. So if you could get a huge pullback in the car companies as a group, Toyota is the one that you pull out of there, because they got the best hybrids. Go to a dealership. Go to dealerships one Saturday. Just go dealership to dealership and check out the cars. Talk to them about hybrids. See what the salespeople are trained to tell you. If you could drive around in a couple of Toyota hybrids, do it. Pretty damn good cars. So the world's changing. It's going to keep changing. The pace of change is going to accelerate, at least for a while, and then it'll level off again. So we'll see how this all goes. But the triple bottom here in oil stocks, with the geopolitical risk, the fact that trade won't impact GDP as much as people are fearing, I think we're going to get a pretty good rally here at some point, and then followed by the pullback, and then another big rally a couple years out. So I'm bullish, but I think it's going to be a choppy ride for a while. All right, have a great rest of the weekend. My girlfriend flies in tonight, so we're going to, like I said, do that show and kind of chill out tomorrow. Go see my parents on Sunday. And if you're in Vegas, try to look me up. I'll be here until June 28th. All right, everybody, you take care. Have a great weekend.